Good morning. My name's Jeremy Wyeth. I'm President and CEO of Treasury Metals. I have with me Orin Baranowsky, our CFO. And we'd like to take a little bit of time this morning to take you through the Goliath Gold Complex, where we've come in the last 12 months, the team we've assembled, and some really exciting news that hit the scene this morning.
Well, it did. I mean, and look, I appreciate you guys taking the time out to speak to us. We haven't spoken since, last quarter of last year. Wanted to talk about the Sprott deal you've just done. Maybe we should kick off with that, and then we'll sort of dive into the project proper and what we're looking forward to in 2022. So, Orin, I guess you're the guy to talk to you about it. So, what's so special about this deal?
Yeah, great. Thanks, Matt. I think this deal is transformative for us. It provides us with the funding that we need to take us through all of the different studies, permitting, community consultation, all the way to a production decision and construction decision next year. So this is the money that will get us to that point in time to where we're looking to build the mine. The details of the transaction of US $20 million for a 2.2% royalty on the Goliath Gold Complex. So it covers our entire Goliath Gold Complex property package. Some of the positive features about it is it does have the right for us up until December 31st, 2028 to buy back 50% of the royalty, and we can use cash or shares to buy that back. And there's an automatic step down of 50% of the royalty once we achieve 1.5 million ounces of commercial production, which I think is an important factor for this. And as we see this as a growing project with multiple targets on our land package, that the upside is capped on that royalty. So some of the concerns that people have with royalties is you're giving away all the upside. Well, we've capped that upside at 1.5 million ounces. We think this is a very attractive financing for the company. It's completed at a significant premium to where our current trading multiple is. It's a difficult equity market right now for developers and in the gold space or in the mining space, and to be able to complete this package with minimal dilution for shareholders, I think is very positive, and it provides us with all that necessary funding, and it's a stamp of approval and an endorsement of what we're doing at Treasury, what the new management team has put in place.
But why now? Because you're right, the markets are difficult, right? At the end of Q3, you had $9.9 million bucks. You raised 6.5, just for Christmas. Could you not have waited a little bit longer to see what the markets would do before doing this deal? So why rush into this?
I don't think we've been looking at this process for, call it 6 months or so now, and we undertook this thinking about it last summer, looking at what are the options available to companies at our stage to fund, to take us through all those studies, to help build value, to take us to that construction decision. And we wanted to look at the options that can be less dilutive to shareholders. Obviously, equity is one of those options, but quite punitive in the market today. And so that's why we decided to go down the royalty path. And this gives us a critical mass to be able to move the project forward, so we can put our heads down and we can put the work into making the project better.
Well, let's talk about that, because I want you're going to get the plaudits and you're going to get the criticisms in equal measure, I suspect, because people have different understandings of the process of raising money, right? So everyone's starting from a different base. So you guys are mine builders. You've done this a few times before. What's the difference to you in terms of getting all the money in place now, which will take you through to that FID, versus raising money incrementally, maybe or maybe not, at higher share price, therefore cheaper money? So when you're weighing those options up, what's the conversation like at board level?
I think the risk going with the incremental funding path is you're always at the mercy of the market at that point in time. And so, we feel this is a risk mitigation measure to have the money today to be able to deploy it as we see fit, so that you don't have to stop and start along the way depending on what markets are like. This allows us to carry through and take longer term decisions as to how we want to enhance the project and looking at those types of items with building Goliath and going forward.
And I think, Matt, I think if you look at it as well, the markets have been pretty brutal for the last 12 months. And I don't think we're necessarily going to see gold seems to be picking up at the moment, which is really positive. But I just don't want to take that risk that we 6 months down the road and the markets have not opened up and we then in even more trouble. We think this is a great deal now. If you look at the way, how we've raised this money and the lower dilution that we've shown and the multiples we've shown, all of that to me is really positive. And it means, we have this really strong team. I want them absolutely focused on getting through the activities to build this, not being stuck worrying about, are we going to be able to get through the next 6 or 12 months?
Okay, so the anti-dilutionary component is a big part of decision making. And again, I think you'll have shareholders that thank you for that. And there'll be others who, if they see this as, I think as Michael Harrison, the managing partner at Sprott Resource Streaming and Royalty Corp said, they see this project as a long-term cash flow in a tier 1 money jurisdiction. You'll have those people that say, oh my goodness, you've just given away 2.2% of the upside of this project. But you put a few little bells and whistles in this deal too. So do you want to talk us through what those are in terms of your ability to kind of claw back, as it were?
Well, for starters, we can buy back half of the royalty. So as the project gets bigger and better, and the economics improve, and as we move closer to a construction decision, the thinking is that royalty is worth more. We can buy back half of it and resell it, or keep those economics for ourselves. And then there is the step down provision on 1.5 million ounces. So as this project grows and the production profile increases, it automatically steps down by 50%. So you're looking today at a 2.2% royalty, but with the buyback and the step down, that's 0.55%. We've taken 75% of that royalty burden off of the asset. And so that's how I would answer people, looking at giving away upside of the project longer term. And the valuation of this is multiples higher than where our current equity trading value. I mean, we're probably in the 0.25 to 0.3 range, and the $20 million is 0.9 times NAV or 0.95 times NAV. So I think given the option to raise money at 3 times your trading multiple, I think most people would make that decision.
Okay, but let's be clear. I want to go through some of the points here that I think you might get some criticism for. So I want people to understand why, again, you felt this was a good deal, right? You've got some minimum payments to make, right? So on a quarterly basis, on the earlier of end of 2027 or commercial production, we'll talk about what that means in a second. It's $500,000 per quarter, right? So you're giving about $2 million a year. Let's say until the end of 2027, right? $2 million a year. Plus the buyback, you can buy 50% back, but you got to pay money. We're talking about $14 million by the end, before end of 24. We're talking $16 million before the end of 25, 17 by the end of 2026, or 18.25 for the end of 2020. I mean, Sprott have got their money back here. So no wonder, I bet they're happy about the deal, but why should your shareholders be happy? It seems like you're giving back a lot of the company.
Well, so we're getting the cash today for the royalty, and then there are these minimum payments included with that. So yes, we can pay those minimum payments in cash, or we can pay them in equity, and it's at our choosing. And the equity is issued at a 5% discount to the 5-day VWAP, which is you're not getting. Today, if you're to do an equity deal, you're looking at probably a 15% discount from your share price, and you have to put in a warrant or a half warrant onto that. So your cost of capital on that equity is way higher than what the street rate would look at things. And our hope is that with this announcement and with the development we're looking to undertake on the project, with the PFS later this year, a resource update, trade-off studies, all those other things. As we move closer to construction, we would expect the equity price to be increasing over time. And so those equity issuances that we're doing are at higher prices than where we are today, which continues to minimize that dilution. And the minimum payments are such that If we it's on commercial production. So if we hit our marks and we do a good job in construction, well, it's sooner than that, right? So, I think we are confident in our abilities to be able to move this project forward, and this financing was put in place with that in mind.
Okay, now, and we've talked before. Both of you have talked with me before. You are a team of mind builders, so I think there's some degree of confidence that gives. But things go wrong, right? So I need to understand which bits are your control and which bits are for you to define and which bits are not in your control. And the bit that sits smack in the middle of that is this phrase, commercial production, because it affects the step down. Because as well as a 50% clawback, there's a kind of step up, as it were, for Sprott if you don't achieve commercial production by the end of 2028, right? So how have you both defined commercial production? Because I've seen some pretty loose interpretations in the market.
I think it's 60 or 70% of nameplate capacity. So we're looking at a 5,000 ton a day mill. So I think it's 70% of that level for, over an average of 30 days. So as long, over a month period, if we average 3,500 tons a day from the plant, we would declare commercial production at that point in time.
So that's just processing ore. It doesn't matter how many ounces come out the other end. If you're whacking in 60% of nameplate, you're good.
Yeah.
It's a pretty, there are quite a few different definitions of it, Matt, but we've looked at what is pretty standard for it. And the way we're looking at the moment, with the Q4 23 construction decision, Q4 25 production startup, and we're looking at probably three to 6 months after that, probably closer to the 3 that will get ourselves to commercial production. So we're looking close to the end of 2025. And, at the end of the day, we've come in, we're backing ourselves to be able to do this. The team we have has done this, can do it. So to me, the important thing is there's always a side to look at what is the downside to it. But the upside for us is that we should be reaching that in around 4 years' time.
Brilliant. Okay, well, that's where I wanted to go. So if you're aiming for the end of 2025, these things are all within a big tolerance for you guys as far as you're concerned. So you feel very, very comfortable with the Sprott terms. And the reason I'm sort of digging into this is because you are going to have your detractors, and I want you to answer them fully as to what gives you confidence to be able to say, this is a really good deal for shareholders now and in the future.
Absolutely, Matt. And we have very happy to answer those questions because we've spent 6 months going through this process at our board level, at our management level, and we've gone through it in absolute detail to make sure that we are comfortable that what we have out there is achievable. And that's what makes this deal so good for us.
Okay. Well, in a minute, we'll get into what you're going to do with the money, right? Because you obviously 6.5 for Christmas. I suspect by the end of Q4, you'll have $6, $7, $8 million left of the 9.9, and I'm intrigued at what you're going to do. But I want to look back because don't forget, last year you're a new team here, right? I think that the company's had a checkered history in terms of perception in the marketplace. Previous management team not quite delivering everything that they said they would. You've come in as a team of mind builders, changed a lot of the processes and way that you are driving this company forward. So, did you do what you said you were going to do in 2021, or did you miss a few things?
Great question, Matt. And I think this to me is fundamental to where we're going. We said at the beginning of the year, we raised money. We said we would drill 60,000 meters. And I think quite a few people said, good luck. We drilled 60,085 meters and we finished those on the 20th of December. So we achieved it. We had some interesting challenges with fires and with all sorts of stuff in the summer, but we got through all of that. We had 3 drills running towards the end, achieved all of that. All of that is in the labs at the moment. One of the challenges has been getting assays out of the labs. And recently, in the last couple of weeks, we've seen quite a pickup in that. So again, we're on track, as we said at that stage, to have a resource out in Q1. So that's all on track. To me, that is absolutely fundamental because that was a large portion of the money that was spent on drilling. We've gone through trade-off studies, and I think we spoke about this last time. There's 2 ways we attack the trade-off studies. One is on the revenue side and one is on the cost side. So on the revenue side, we did a whole lot of met test work for Goldland and Miller. And we almost complete, we're very close to completing that, but seen very good results and good improvements on Goldland and Miller. So from a revenue perspective, there's a bump. We also looked at silver. So we started testing silver about halfway through the year, found that we were getting silver in the Goldland and Miller assays. So now we've gone back and actually sent thousands, I think it's about 3,500 samples to the labs, so that we can now actually include that. It won't be in the next resource we do because the labs just can't process that amount, but it'll go into the PFS and the FS. So again, there's another bump on the revenue side. On the cost side, we've gone through a whole host of trade-offs, one of them being haulage. We're looking at the options. The PEA was trucking. We're looking at railway, conveyor, pumping. They're all different options there. We've got them to a point now where we're doing additional details, but we're waiting for the resource because we need to apply this to the new numbers. Infrastructure is another big one where the PEA had $10 million on infrastructure for the mine. Now, the tree farm that we have at Goliath is fantastic infrastructure. It was a facility with about 400 people working in it before we bought it from the government. So we believe we can save 60 to 70% of that $10 million purely by redoing and working with that facility rather than building a new one. We're talking offices, we're talking workshops, we're talking laydown areas, all of that sort of thing. We've looked at the tailings. Previously, 2019 was when our EA was done, and we were looking at subaqueous tailings. And we all know that the world has changed quite significantly, and most areas are looking at subaerial. So we're going from saturated to non-saturated. And we see, first of all, a better technical solution. We see it easier to construct, easier to operate, easier to monitor, easier to close, and potentially cheaper. So again, here's another opportunity to feed into that cost side of where we are. I said earlier, the last quarter in 2021, we looked at a lot of exploration targets. So the first half of the year was very much the conversion and looking at that. Moira Kolb actually brought both the models together for the first time, and we've got some really interesting targets for this year, which I'll talk to a bit later. And as we're getting these results now, in the last couple of weeks, we're starting to see results from the Far East, from the fold nodes, all those areas that we were really excited about. And, we're going to push as hard as we can to try and get some of that into this resource update. So I'm going to say watch this space because, those were looking really good at the logging stage. And I want to see when those results come back, how that takes us. Probably the last area that's also quite significant for us is previously we always looked at Goldland as greenfields. The fact is Goldland was an operating mine in the 80s. And it was never closed. So we still have permits for Goldland. So we've dug in and we've found some of this stuff dating back 40 years. And now we're looking at how we can turn this to our advantage, where it becomes a brownfield operation rather than a greenfield operation. So where we thought Goldland was potentially going to be a year behind Goliath, we're actually looking now, we don't have all the answers yet, but we are really pushing hard on this because this could become another opportunity for us to bring things ahead. So, we're attacking the revenue source, the cost source, the schedule. And I think you can see here that this is the approach of a team that's been there before. We're not just going to make this an exercise. We're actually looking really, really detailed at how we can improve the financials, the schedule with the team that we have in place. So
that's interesting to me. So, right, the 60, 70% savings on the 10 million is remarkable, but saving money, on the PA is great, but it's going to come back to the size of this resource and how much of the historic information is coming through into the new study, you must have an idea now. 60,000 meters, even visually, you geos what you've got there, and obviously the assays are slow coming through. So strategies are important. I've seen companies destroy their shareholder value by coming out with a resource which is smaller than the market is expecting. So, one, do you understand the size of the resource that the market is expecting? Have expectations been set either by you or previous management? And would you delay putting that resource out if you didn't think that you could hit that number?
Matt, I think, everybody would like the resource to be way bigger and way better. We understand that. To me, the important thing is, if you look at our previous resource, it was 2.5 million ounces, of which only 1.1 went into the mine plan. So I'm not in a game of making the resource much bigger. I'm actually in a game of making the mine plan much bigger, because I actually get value out of the mine plan, not out of the resource. Yes, the resource is important. I think for us, absolutely. And I'm not delaying putting the resource out. I'm actually trying to get the benefit, as you said, of the 60,000 meters. Initially, I thought I wouldn't get the exploration results, but I'm actually starting to get those. So we're now dealing with the conversion, Goliath, Goldland, and Miller. And then I'm looking at those others, because I believe there's opportunity for us there, just like we found Miller in the last resource update, that the Nosefold and the Far East are definitely out there with historic drilling and the drilling we're now getting in. This, to me, is a really exciting opportunity for the company, and at the same time, pushing really hard that the PFS will show us that our conversion rate is way more than 50%, which is what it was in the PEA.
Right. Okay. So we're talking about Q1, right? We're talking about Q1 for a resource, right? End of Q1.
Yeah.
Right. Fine. And you've indicated the sorts of numbers that have been talked about in the past, and the paperwork talks about the life of mine and the grade, etc. So if you can give the market confidence that this is recoverable ounces, we're talking about here, that you can actually deliver it technically. What does that do for the cost of money further down? I know we're at PEA stage, it's so early, but you talk about an accelerated study process that you're going into, and yes, you've got to get the permitting sorted out and actually get the finances in place at some point. But given that, I mean, what do, again, from your experience of building mines in the past, what does that do to the cost of money, getting the right mine plan in place rather than just broad inferred numbers?
It's critical. The resource is coming out Q1. End of Q2, we're going to have the PFS out. And that's the first time we start seeing the conversion from resource into mine plan into the financial model. And then, there are things that I can't get in at that stage. The silver, that'll come in after that. As we're moving this forward into FS, I remember saying, I think in our first interview, that I see this as a resource that's conservative, that will grow from PEA to PFS to FS. So that's important for me, but even more important is that growth in the mine plan and the reserve of what we're actually that's what drives our revenue line. So that, Matt, is where, I see the opportunity there is, it would be silly for me to put out the resource before I get all the results back. So that's exactly why we're waiting. And we are continuing, and maybe I can just touch briefly on the 2022 program that we have in place. It's 25,000 meters this year, quite a bit smaller than last year, and it's entirely exploration targets. So you did a call with Moira a while back where she spoke about the excitement around all of these folded areas. Some of them have never been drilled because of just the complexity of getting to them. It's hard to believe at the moment. We've had temperatures below -40 in Dryden for the last month. And some of these areas have not frozen up yet. And the reason for that is we had a big dump of snow early on in the season, and it's insulated it. So we're now in there clearing the snow away so that we can get access to these areas. But all of those are just really what we need now to push this to the next stage.
Okay. Looking at costs, getting costs down, making sure that you're technically able to deliver a resource and go through the study phases relatively quickly. Let's look at the share registry, because you've got First Mining and First Mining shareholders in there, over 30%, whatever, 32, 33% of this thing, right? That, which is great while they hang on to this. And as you go through your accelerated phase, some people may feel that they want to exercise those. They may want to cash in on that one. With Sprott coming on board, what does that do in terms of your ability to bring in more institutional shareholders, because they're only at 30% at the moment, or indeed make sure that there's a kind of managed offload of First Mining shares should that situation ever arise, because you do need to manage that. Otherwise, it's a massive overhang for you guys.
The First Mining shareholders that came on the distribution, from First Mining back in the summer, I think a lot of those shareholders are still there because they bought into First Mining on the belief of building mining projects, and they like that we have a team in place that is looking to advance and build a project. I think this financing will hopefully, I think we'll see an increase in institutional ownership because, again, Sprott investment is that stamp of approval that this is a management team that is going to advance this project forward. We're moving from being just kind of one of the other developers to a developer that's going to get it done. And that's, the institutional market, they're picking their horses, right? And I think we're a horse that you can back. And I would look at this as something that would be attractive to institutional investors and would see, I would expect to see our institutional registry increase.
And also, Matt, we've seen First Mining with the distribution are now down to just under 15%.
Yeah, but I think also First Mining shareholders themselves have got another 17. Is that right?
Yes. Yes.
So between and we did speak to the First Mining CEO, and he recommended his shareholders that they obviously take this deal, but also more importantly hold on to the shares because he understands what you've got there. And I don't think that position has changed, but it was a question of relationship between First Mining CEO. If they do make a decision, do they engage with you, and you do it in a controlled manner, and to your ability to then find friendly hands in which to put it. So removing the kind of fear of any kind of overhang or dumping into the market, and restricting your ability to go through those sort of step changes of creative growth.
And Dan and I chat on a regular basis, Matt. And the other thing that was really interesting, if you remember, there was a lot of concern in the markets that the distribution was going to be an event that could cause huge volatility. We actually found after the distribution, it went well. There was no volatility. In fact, there was a little bit of volatility just prior to it. But if you look at us compared to our peers, we actually did really well from July onwards. So I think we've seen, as Orin said, a lot of those shareholders bought in for the development story. And I think they're very happy with what they've now got in this project, which they got from buying in originally into First Mining.
Interesting. And so you mentioned 25,000 meters. Is that fully funded with the current?
Yeah, the flow through funding that we did in November of last year of $6.5 million is paying for the exploration program this year. And it would be amazing for us to have some new successes, new drilling that shows new targets on the property where we could opportunistically look to focus drilling on some of these targets.
Okay, with regards to the Sprott deal, so I should have asked you that at the time. It was like it relates to the Goliath complex, right? So what percentage of your total holdings is that? Is there some blue sky which doesn't have an NSR over it?
I mean, we have some, we have 100% ownership of an early stage exploration target that we're going to do some grassroots exploration work on this year, and we have a 49.9% interest in another property. But the bulk of our focus is on the Goliath Gold complex, and the Sprott funding covers the non-exploration side. So it funds all the studies, it funds the work that is required to take the project from the stage it's at today to where it's a financeable project to build.
I think, Matt, it's fair to say we scaled down on the drilling because with the delays in getting assays out of the labs, it makes sense for us to really get the best value for money in the drilling. And what that is requiring is that we do a few holes and then wait for results and then go back. So first prize for me is we get some good results back from the Nosefold and the Far East and the Interlakes and those areas. And then we go out and get some additional flow through funding. We didn't battle to fill the 6.5 million last in November. And I believe on good results, we'll be able to raise additional. So the Sprott money is the hard dollars for the studies, the permitting, the community work and corporate work. But as I say, first prize would be we get some really good results. Fingers crossed, watch this space. And we can take that, bring in some extra dollars, and then fast track that to get it into, probably won't make the PFS, but it will be into the FS. And to me, this is not a sprint. This is to get to production. So if we see good results, we bring this in, we do the drilling, it's systematic, we add it, it means our FS becomes even stronger. And that's what I committed to. PEA, PFS, FS, growth all the way.